You can always tell when a market is whispering to you before it ever raises its voice. That's what I want to talk about today. And just like I mentioned in the previous video on if you are starting from zero, knowing how to begin is one thing, but knowing what to look for next is what keeps you alive in this business. Now, when I speak about early market signals, I'm not talking about some magical tip from a broker or a rumor that drifts down the street. I mean the sort of clues a patient trader learns to recognize from the tape, the trend, and the tone of the market itself. Have you ever watched a chart and felt something shifting long before the crowd noticed? That feeling isn't luck. It's observation trained through discipline. I learned early in my career that most folks look at the market the same way they glance at a clock, quick, casual, and without much thought. But the market doesn't reward casual glances. It rewards the trader who studies the behavior of price the way a naturalist studies the tracks of an animal. Quiet signals, small changes, little tremors, these are the footsteps that lead you to the next big move. You might ask yourself, what exactly am I supposed to look for? Well, that's the funny thing. The signals aren't complicated. They're simple enough, but simplicity is the hardest thing for most traders to trust. Take a rising market that suddenly stops climbing even on good news. That's a signal. Or a falling market that refuses to sink despite bad news piling up. That's a signal too. How many traders ignore those moments because they're chasing the story instead of the action? Before I ever made any meaningful profits, I had to accept that the market speaks long before it shouts. It whispers through volume drying up, through price tightening, through a pullback that behaves too well to be mere chance. Do you ever notice how the tape quiets down before a real move, like a man drawing breath before speaking? Those pauses are part of the story. And you know, early signals aren't only about technical moves. They're also about your own behavior. A trader who's uneasy, fidgeting, forcing trades. That's a signal too. Maybe the most important one. The market teaches you to read yourself as much as you read it. If you don't catch your own warnings, how can you expect to catch the markets? What I'm trying to tell you is that early signals are simply the first cracks in the wall or the first bricks laid for a new foundation. Nothing dramatic at first. You need the patience to wait for confirmation, but also the alertness to recognize the first shift. Have you ever noticed how the best moves look? Obvious only after you've missed them. That's because the signal was there. You just didn't trust it. In the previous video, I said that starting from zero means learning to build your trading from the ground up, slowly, deliberately, and with respect for the craft. Today's principle ties right into that, because seeing early signals is part of growing beyond beginner habits. Beginners react, experienced traders anticipate. If you watch a stock forming higher lows while the market feels heavy, that's a sign of strength. Not a guarantee, but a sign. Or imagine a stock that keeps getting sold down, but refuses to break through support, even though everything else is sinking with it. Don't you think the strong hands are telling you something? Markets don't hide their intentions. Traders just distract themselves from the obvious. Of course, you must avoid jumping at every shadow. A signal is not an invitation to gamble. A signal is a nudge that says, pay attention. My biggest mistakes came when I treated hints like certainties. Maybe you've done that yourself. Seen a small move and thought the whole trend had already changed. The market loves to remind you that impatience is expensive. Money in the market is made by sitting tight when you're right and stepping aside when you're wrong. But the decision to sit tight or step aside comes from recognizing the earliest hints of strength or weakness. Some traders wait for perfect clarity. They want every condition to line up neatly before acting. But tell me, when has the market ever handed you perfect clarity? It gives you fragments, little pieces. You assemble the picture. Early signals also separate a trader's mindset from the gambler's. A gambler bets because he hopes. A trader acts because the market has shown enough to justify taking the risk. I never made a dollar that lasted by hoping. I made money by watching for changes in behavior. Tight ranges after a decline, unusual strength in a weak sector, a breakout that doesn't retreat when tested. If you've ever caught one of those moves before the crowd pounced, then you know exactly what I mean. One thing that often surprises new traders is how quiet real opportunities feel. They don't roar, they don't glow, they slip in like a whisper. A chart that's been dead suddenly shows a pulse. A stock that's been dull starts attracting steady, subtle buying. Have you ever found yourself staring at a chart because something just felt different, even though you couldn't quite articulate it? That sensory awareness comes from experience, but the clues are there long before the feeling develops. Another important point: early signals aren't always bullish or bearish in the way beginners imagine. They're about behavior, not direction. A market that stops descending isn't necessarily about to rise. It might just be catching its breath before dropping further. That's why you need confirmation. Not through opinions, but through price acting as it should if your signal is authentic. The market confirms truth through movement. And remember, early signals don't belong to any single indicator. Moving averages, trend lines, volume bars, these are tools, not gospel. The real signal is the behavior underneath. Tools help you measure it, but they don't replace judgment. Have you ever seen a trader load their chart with so many indicators they can't see the price anymore? That's a trader searching for certainty instead of understanding. No matter how long I traded, I kept learning that markets reward the man who observes with patience and punishes the man who acts with impatience. Early signals ask one main thing from you: the discipline to notice them without rushing to action. That's the part most traders never master. They want the signal to be the trade itself. But the trade comes later. Signals are only the beginning. Price hesitation at key levels often marks the first shift in market sentiment. And if you've traded long enough, you know that hesitation is rarely accidental. It's one of those early signals the market gives before it makes up its mind, and yet it's the signal most traders overlook because it doesn't shout, it whispers. When price approaches a well-watched level, support, resistance, a prior high, a psychological number, the behavior there tells you more about the market's intentions than any indicator ever will. It's where buyers and sellers show their true conviction. And the funny thing is, the first sign of that conviction isn't always aggressive buying or selling, it's the subtle slowing down. Think for a moment about how markets move. When participants agree on direction, price moves swiftly. There's alignment, momentum, and almost a sense of urgency. But when price reaches a point where opinions differ, where some see value and others see risk, movement naturally slows. This hesitation isn't a random pause, it's the market weighing its options. Have you ever noticed how a strong uptrend marches confidently until it hits a level everyone remembers? Suddenly the candles get smaller, the volume softens or becomes erratic, and the market feels like it's holding its breath. That's the moment to pay attention. Price hesitation tells you that the balance between buyers and sellers is shifting, even if only slightly. Sometimes buyers are getting tired. Other times sellers are losing confidence. But either way, the hesitation signals that the prior momentum is no longer moving freely. And in markets, when momentum hesitates, change is nearby. This doesn't guarantee reversal or continuation, but it does guarantee that pressure is building. A shift in pressure is always the seed of the next move. Picture a stock rising into a major resistance area. If the trend is still healthy, you'd expect strong conviction as it tests the level, expanding candles, firm closes, maybe even a quick push through. But if what you see instead is stalling, small candles, wicks on both sides, indecision, then that resistance is not just a line on a chart. It's a battleground. The market is revealing the presence of supply. Sellers might not have taken control yet, but their activity is enough to make buyers hesitate. And hesitation from buyers is often the first sign that strength is fading. Now shift the scenario. Consider a downtrend approaching long-term support. You expect it to slice through if the selling pressure is strong. But instead, price starts bouncing slightly, candles shrink, and volume becomes hesitant rather than aggressive. What does that tell you? It tells you someone is stepping in, maybe quietly, maybe cautiously, but stepping in nonetheless. Those are early signs of demand. It doesn't mean the trend is over, but it means the market is no longer one-sided. And once a market stops being one-sided, it's often preparing for a change. One of the most misunderstood ideas in trading is that big moves come from big signals. In reality, big moves often start with tiny clues. Price hesitation is one of those clues. It's the slight change in temperature before a storm, the pause in the tide before it reverses. If you're waiting for obvious confirmation, you're already late. Early market signals are rarely obvious. They require attention and patience, two qualities that most traders underestimate because they want action, not subtlety. But it's the subtlety that keeps you ahead of the crowd. When price slows at a key level, your job isn't to jump in or rush out. Your job is to observe. What's the character of the hesitation? Are buyers struggling to push higher? Are sellers losing their grip? Does volume confirm the hesitation or contradict it? These questions sharpen your read of the market. They help you interpret what the hesitation means rather than simply reacting to the fact that it exists. Sometimes hesitation signals continuation. Other times it signals reversal. The meaning depends on context. For instance, if a price trend pauses at resistance but shows no sign of strong selling, just a temporary rest, it may be gearing up for a breakout. That quiet consolidation is an early signal of energy building. But if hesitation at resistance comes with expanding upper wicks, dropping volume, or failed attempts to push higher, that hesitation is warning you of weakness. Likewise, hesitation at support can either mean absorption of selling, signaling that buyers are preparing for a push, or it can mean a lack of interest from buyers, showing that support is weakening. This is why hesitation is not a signal you trade on its own. It's a signal that tells you to pay attention, to prepare, to anticipate. The opportunity comes when the hesitation turns into decisive movement. But without recognizing the hesitation first, you won't see the decisive movement early enough to capitalize on it. What makes price hesitation so valuable is that it reflects real time shifts in sentiment. It's not a lagging indicator. It's not a theoretical model. It's the market showing you its internal struggle. An internal struggle always comes before external movement. Most traders ignore this because it doesn't flash or blink or offer certainty. It simply offers possibility. But in trading, early possibility is often more profitable than late certainty. When you learn to read hesitation, you start seeing transitions before they happen. And once you can see transitions early, you begin to understand the market the way seasoned traders do. Not as a set of signals to follow blindly, but as a living structure of human behavior that leaves clues long before it makes a move. A trend losing momentum signals exhaustion long before a reversal ever shows itself, and if there's one lesson traders learn too late, it's that momentum fades quietly. The market doesn't announce exhaustion with alarms or flashing lights. It reveals it through subtle shifts, slower candles, weaker pushes, hesitant follow-through. This is the sort of early signal that separates traders who react from traders who anticipate. Think about it. Have you ever watched a strong trend that suddenly felt different even though nothing dramatic had happened on the chart yet? That feeling usually comes from these tiny changes in momentum that most ignore. Momentum is simply the force behind price movement. When buyers are eager or sellers are aggressive, momentum is easy to spot. Candles stretch, pullbacks stay shallow, breakouts follow through with purpose. But when that force weakens, price still moves, just not with the same confidence. It's like a runner who's still going forward, but starting to breathe harder, shorten their stride, and lose rhythm. They haven't stopped yet, but you can sense it's coming. The same thing happens in markets. A trend may still technically be intact even while exhaustion quietly builds underneath it. Consider an uptrend that has been running smoothly. Higher highs, higher lows, clean pullbacks, strong buying pressure. But then something changes. Each push to a new high becomes smaller. The breakout that once leapt forward now barely steps past the prior peak. The candles lose their length, the closes lose their strength. Have you ever caught yourself saying, "It's still going up, but it doesn't look as strong"? That's not your imagination. That is the early decay of momentum. The beauty of noticing momentum loss is that it gives you time. Markets rarely reverse out of nowhere. They slow first, then stall, then turn. If you're waiting for the turn itself, you're already late. If you spot the slowdown, you have a chance to adjust, tighten risk, take partial profits, stop chasing entries, or prepare for a change in behavior. Most traders never develop this sensitivity because they're trained to focus on price direction, not the quality of that direction. Watch how the trend behaves near resistance or support. In a healthy trend, price attacks those levels with energy. But when momentum weakens, the market starts drifting into them instead of charging. The angle of ascent or descent flattens. What used to be sharp impulses become rounded moves. Volume may decrease or become uneven. It's the market's way of saying, "I'm getting tired." And tired markets respond differently. They're more vulnerable to shocks, more easily pushed around by sudden orders, more likely to break their rhythm. In a downtrend, the same principle applies, but in reverse. Strong downtrends slice through support levels with ease, but weak ones start bouncing a little higher, consolidating a little longer, showing hesitation where there was none before. Some traders think this hesitation means buyers are suddenly in control, but that's not always true. Sometimes it simply means sellers are no longer hitting the market as aggressively. Exhaustion isn't about the other side winning yet. It's about the dominant side running out of steam. You can see momentum loss in the shape of candles. Strong momentum tends to create long, clean candles that close near their highs or lows. Weak momentum produces smaller bodies, more wicks, more indecision. Have you noticed how trends often end with choppy, overlapping candles? That's exhaustion speaking in plain language. It's not the clean, decisive movement that started the trend. It's sloppy, tired, inconsistent. But be careful, momentum loss does not automatically mean reversal. Sometimes a trend simply pauses, catches its breath, and then continues. This is where context becomes everything. Look at the bigger picture. Is the market approaching a major level? Is sentiment stretched? Has the trend been running for too long without a meaningful pullback? When an extended trend starts showing signs of fatigue, those signals carry more weight. But when a fresh trend hesitates slightly, it may simply be consolidating before resuming. As a trader, your job isn't to predict reversal. Your job is to detect when the odds are shifting. When momentum weakens, the probability of risk increases. It may still go in your direction, but the advantage is slipping. And trading is about advantage. When you're aware of momentum shifts, you naturally develop a better relationship with your positions. You stop overstaying. You stop forcing trades. You stop assuming the trend will do all the heavy lifting for you. Some traders rely too heavily on indicators to tell them when momentum is dying. But indicators are often lagging interpretations of what price already showed. The earliest signal is always in price action itself. Look at the speed. Look at the smoothness. Look at the conviction. A trend with real strength moves almost effortlessly. A tired trend struggles. It pushes, then sinks. It rallies, then stalls. It tries to continue but fails to follow through. If you've ever held a trade and felt uneasy even though the chart still looks okay, that discomfort often comes from subtle momentum loss your eyes noticed before your mind did. Learning to trust those observations can give you an edge, because exhaustion comes before breakdown and before breakout failure. And once you train yourself to see it, you begin reading the market the way seasoned tape readers do. Not through predictions, but through behavior. Divergence between price action and sector behavior can expose hidden strength or weakness long before most traders catch on. And this is one of those insights that rewards the trader who pays attention to relationships rather than isolated movements. Markets don't move in a vacuum. Individual stocks don't simply wander off on their own path without some form of influence from the broader group they belong to. When a stock behaves differently from its sector, the divergence is often the first clue that something underneath the surface is changing. Have you ever looked at a chart and wondered why one name refused to follow the rest of its peers? That refusal is rarely random. It usually means something is building: pressure, demand, exhaustion, accumulation, or distribution. Think about it this way. Sectors represent the collective mood and direction of a group of related stocks. They are like the tide, and the individual stocks are the boats. Normally, boats rise and fall with the tide. When the sector moves up, its components tend to rise. When the sector weakens, its components usually follow. So when you find a stock moving opposite the tide, or failing to follow the tide with the same conviction, that divergence is telling you that the stock is not responding to the same pressures driving the rest of the group. And in markets, differences matter. Differences are signals. Consider a sector that's been gaining strength as a whole, lifting most of its stocks with it. But one stock in that group refuses to move higher. While others push to new highs, this one struggles, lags, or barely budges. That's not just a weak performance, it's a message. It suggests the stock is either under distribution or lacking the buying pressure that is present elsewhere in the sector. If the entire group is strong but one component can't catch a bid, you have early evidence of internal weakness long before the chart shows a clear downtrend. Have you ever asked yourself why a stock lags even when everything around it is roaring? That's your clues sellers are active in that name, even if the broader sector is masking the weakness. Now flip the scenario. Imagine a sector in decline, falling across the board, dragging most names down with it, but there's one stock that refuses to crack. While others break support, this one holds steady. While others make lower lows, this one forms higher lows or stays flat. That's what real strength looks like in its earliest form. It's a signal that strong hands are accumulating even as the rest of the sector bleeds. When a stock resists downside pressure in a weak environment, it is often the first one to explode higher when conditions improve. This kind of divergence is the fingerprint of accumulation, and if you've ever watched a strong name lead a new sector rally, you've likely seen this behavior before the move happened. Sector divergence isn't only about price, it's also about how stocks respond to news. If a sector reacts negatively to some macro event, but one stock shrugs it off or recovers quickly, you should pay attention. Markets often reveal their intention in how they digest information. A stock that stops selling off during bad news is often stronger than it appears. A stock that can't rally on good news is often weaker than it appears. The sector merely amplifies this by giving you a baseline to compare behavior against. One of the most overlooked parts of divergence is timing. You don't need a huge difference for it to matter. Sometimes the earliest clues show up inside a single trading session. Maybe the sector is red, but one stock keeps making small intraday higher lows. Or the sector is green, but one name is stuck under a small resistance zone it used to clear easily. These tiny differences can be the seeds of major moves. The market rarely reveals its hand all at once. It gives pieces. Divergence between a stock and its sector is one of the clearest pieces you can catch. If you're actually looking, what makes this concept powerful is that it helps you avoid chasing the wrong names. Traders often get excited about the stocks that look the strongest on the surface, but if that strength isn't supported by the sector, it may collapse when the broader group hits resistance. Likewise, some traders avoid stocks that look sluggish, only to watch them become the leaders once the sector turns. This is where divergence becomes a practical tool. It keeps you aligned with the strong while warning you when the weak are pretending to be strong. You can also see divergences show up in volume. A stock lagging its sector but showing rising volume on down days is waving a red flag. Meanwhile, a stock outperforming its group while attracting steady accumulation volume is often preparing for a real breakout. Price tells the story, but volume adds the tone. And when the tone doesn't match the sector's rhythm, something unusual is happening. Have you ever watched a stock break out while its sector sits flat or pulls back slightly? That's leadership. Leaders reveal themselves through divergence long before the trend becomes obvious. And on the flip side, have you ever held a stock that kept sinking even though the rest of the sector recovered? That's the kind of weakness divergence exposes early, giving you the chance to protect yourself before the decline becomes brutal. Divergence between a stock and its sector isn't a trick or a shortcut. It's a lens that helps you judge behavior in context. On its own, a price move can deceive you. But when you compare it to the group it belongs to, the truth becomes clearer. Markets are built on relationships between sectors, industries, stocks, and the flows of capital moving through them. And when one part of that relationship breaks pattern, the break itself is a signal worth noticing. Repeated tests of support or resistance show where true conviction sits, and if you've spent any time watching charts, you know the market rarely makes its intentions obvious on the first touch. Markets probe, hesitate, retreat, and return. Each test reveals more about who actually controls the territory, buyers or sellers. Have you ever stared at a level that price keeps coming back to and wondered why it won't just break or bounce cleanly? That tug of war tells you far more about future movement than any single candle ever could. Support and resistance aren't magical lines. They're simply areas where buying or selling pressure has proven itself before. But it's the repetition that matters. When price returns to a level again and again, the market is essentially asking a question. Is the conviction still here? Each test chips away at the order flow on one side while strengthening the message on the other. The more times price tests a level, the more information you gather about the mindset of traders involved. Think about support first. Suppose a stock falls toward the same zone multiple times and bounces. On the surface, that looks like strength, buyers stepping in each time the price dips. But how the bounce behaves matters just as much as the fact that it happened. Do the bounces get weaker each time? Do they rise less, fade quicker, or stall sooner? If so, the repeated tests are telling you buyers are getting tired. They're doing enough to defend the level, but not enough to push price meaningfully higher. Have you ever seen a support zone hold beautifully right before it completely collapses? That collapse usually comes after several tests where the market slowly drained buyer conviction. Now flip it, the bounces get stronger. Price doesn't just hold, it springs upward with growing momentum. Volume increases. Pullbacks become shallow. That tells you this isn't just support, it's a real foundation. Buyers aren't only defending the level, they're gaining dominance. Repeated tests in this case don't weaken the structure, they reinforce it. A level like this often becomes the launchpad for a major move. Resistance works the same way, just in the opposite direction. When price rallies into a resistance zone repeatedly and gets rejected, the first instinct is to say sellers are strong. But watch closely. Do the rejections drive the price deeply lower, or do they only cause shallow pullbacks? If each rejection becomes weaker, that resistance is crumbling. The sellers haven't lost yet, but they're losing ground. Have you ever noticed how the strongest breakouts happen after price knocks on the door several times? Those repeated tests weaken the supply sitting there, until finally, there's nothing left to hold price down. But when resistance holds firmly and pushes price down with force, that tells you sellers are waiting with true conviction. Maybe the level aligns with a long-term trend line, maybe it's tied to fundamental concerns, or maybe it's just where large participants prefer to unload shares. Whatever the reason, repeated rejections with strong downside follow warn you not to expect a clean breakout anytime soon. What makes repeated tests so revealing is the psychology behind them. The market is full of participants with different time horizons, strategies, and emotional thresholds. When price repeatedly tests a level, it draws all those players into a tighter and tighter decision zone. Bulls who bought early get nervous. Bears who sold early get uncomfortable. New participants take positions. Positions shift. Pressure builds. And pressure is the root of every major breakout or breakdown. Another part traders often ignore is time. How fast price returns to the level matters. If support gets tested 3 times in a single week, that's different from 3 tests over 2 months. Quick, clustered tests often hint at urgency. Either buyers aggressively defending or sellers aggressively attacking. Slow, spaced, out tests reflect a more measured battle. Both types of tests offer clues, but they imply different things about who is pushing the market. Volume also plays a crucial role. A support level that holds but attracts decreasing volume each time may be weakening. A resistance level tested with rising volume each time may be close to breaking. Volume doesn't need to be dramatic. It just needs to tell you whether traders are becoming more engaged or less engaged as price returns to the level. Have you ever tried to force a trade because a level looked too obvious? That's the tricky part. The market knows traders focus on support and resistance. It knows people tighten stops around these zones. That's why false breaks happen. But even false breaks are part of the information. A level that shakes out traders but pulls right back above support or below resistance is revealing where real conviction lies. Those traps often show that the opposing side lacks genuine strength. Repeated tests are also a reminder that the market isn't a static battlefield. Each test changes the structure. Stop orders get hit, new orders get placed, sentiment evolves. What looked like a strong level early in the trend may become weak over time, and what looked weak may strengthen depending on the flow. When you watch a level get tested over and over, you're watching a slow negotiation between buyers and sellers. Neither side wants to give in easily. But eventually, someone does. The breakout or breakdown isn't the beginning of the move, it's the conclusion of a long dialogue. The real edge comes from paying attention to the dialogue itself, rather than waiting for the final answer to appear.